It is time for our ETF Spotlight. Bob Pisani's with us. He's taking a look at how financials are faring on the heels of banks reporting results, of course, during the course of this week. Bob.
Thank you very much, David. It's been a big week for bank earnings, and the bank ETFs have seen very active trading, but they're not all the same. Indeed, the two largest bank ETFs are very different creatures. Let's take a look here. The big kahuna in this space is the Financial Select Spider, or XLF as we call it. They're all the financial stocks in the S&P 500. That's nice, but here's the problem. Less than half are banks. They include a lot of insurance companies, for example. Like most sector ETFs, it's market cap weighted, so the largest stocks have an outsized influence. Indeed, take a look here. The top 5 holdings are 43%, 45% of the weighting of the whole index. So this includes companies like Berkshire Hathaway. Berkshire Hathaway is not a bank. JP Morgan, Bank of America, Wells Fargo, Citigroup. You essentially buying 5 companies when you buy this ETF. Now, that's not the case with its rival, the Spider Bank ETF. This is the KBE, we always call it. This is essentially an equal weighted index of about 80 banks, big and small. There's no insurance companies in this. There's no Berkshire Hathaway in this. All right, so what? What's better to own? So here's what tends to happen. During big sell-offs, the banks tend to do worse than the insurance companies, as we saw at the end of December. The banks underperform. But during rallies, which is what we're in now, like we've seen in the last several weeks, the banks tend to do better. So the KB has been up over 13% this month. The XLF is up only 8%. So the bottom line with this whole ETF thing is very important to know what you're owning and what particular part of the cycle that you're in.